number, and running different balances of checks, you find out what will clear, you know their bank account balance. And I don't know if you've read in the newspaper lately that banks now are sharing all their information with telemarketing companies. They give out your name, social security number, your account balance, everything to telemarketers. So they can market you for other services like life insurance. So there really is no bank secrecy in the United States. Even though they have a thing called the Bank Secrecy Act, it just doesn't have any meaning at all. But offshore, the banks we use in international jurisdictions have very, very strong, very, very powerful bank secrecy. The bank secrecy is by civil and criminal law. That means any bank officer, any bank employee that releases information could be sued, the bank could be sued, and they could be criminally liable for releasing banking records and banking information. So people always ask me about offshore banking. Isn't that dangerous? Isn't that inconvenient? Well, I always make the analogy that when you bank offshore, it's similar to people overseas banking here. So when somebody comes here and opens up a bank account and they ask me, I have, for example, a client from Taiwan or Japan or Korea or anywhere, South America, they come to me and go, well, who is Wells Fargo Bank? Are they solvent? Are they secure? Well, of course. You know, we know here that these are very solvent and secure banks. Same thing offshore. Barclays Bank, one of the largest banks in the world. They don't do much banking in the U.S., so people aren't familiar with them, but globally, they're more powerful and stronger than most banks in the U.S. So we really feel that the secrecy is very, very powerful offshore. The convenience, actually now when you do your banking, you usually have an 800 number. You're not talking to your local branch anymore. You're talking to somebody in Chicago or somebody in New York or somebody in Atlanta that does all your banking for you by an 800 number. And they can pull up all your information by computer. They don't want you talking to the local branch anymore. So what's the difference of calling Atlanta or calling to Bahamas, for example, or calling Miami or calling Cayman Islands? Same time zone, 3 hours time difference. You dial an 800 number or you dial a local area code. Either way, you're going to get through to the banking officers and the bank people that you need to deal with. The safety, very, very secure. The banks we use, some of the largest in the world. Actually, banks offshore are more or less like stockbrokers. Here we have stockbrokers separate from banks. In Europe, they've merged them. So when you call up your banker offshore, they're going to ask you what kind of securities, bonds, what do you want to buy, foreign currencies. They allow multi-currency accounts, much more sophisticated than banking here. And they manage mostly assets on behalf of clients. So when you invest your money offshore, you're not just investing it with a bank. When you put a deposit with Bank of America or Wells Fargo, that is your deposit. Your risk is that the bank fails if it's over and above the insurance limit. Well, what happens offshore is your risk is not bank failure, because what your risk is what you invested in. So you don't just invest it in a regular passbook account. You invest it in securities, bonds, stocks, whatever you're going to buy, mutual funds. Your risk is really investment risk. So your risk is that you buy the wrong asset. If you're going to buy internet stocks and they're going to drop in value, well, so be it. You lost your money. If you're going to buy gold and it goes further down, you've lost your money. So you need to take an intelligent approach and do asset allocation. You have to minimize your risk. You have to set up a portfolio, a managed portfolio that either you manage or you have professionally managed on your behalf. And people always wonder, well, these offshore banks, Swiss banks, my gosh, you must have at least 2-3 million to open the account. Well, some do designate those large balances, and that's because they're trying to attract that type of clientele. But we also have smaller banks that really want your business with just a nominal balance, like $1,000. Well, they're retail banks. They want to get your credit card that works as an ATM machine, through an ATM machine. They want you to have a small bank account that they can charge you, nickel and dime you for small transactions. Well, they just make it up in a big volume. That's fine. You're not going to get the personal attention of a private bank offshore. The Swiss bankers, they're going to fly here to meet you if you put in a substantial deposit. Luxembourg bankers will fly here. Cayman Island bankers will come here. You'll meet with them somewhere to go over your investment objectives. But not for the small balances. You're going to be dealing with a computer, maybe a website where you can access your data through an encrypted code. If you want the more sophisticated banking, we need to build up the balances a little bit, to keep them happy that you're an investment type client. So offshore, you can put your assets in there. Your risk is minimal, just your investment risk only. Very, very safe. Tax neutral. People think offshore, tax-free. Well, it's tax-free in the foreign jurisdiction. Where you invest the money, there's no tax. Actually, we have reciprocal tax treaties with a lot of these countries. And people ask about tax havens, I tell everyone the same story. The biggest tax haven in the world is the United States. All the people around the world put their money in the U.S. because here it's tax-free to foreigners. You pay tax on the money invested in U.S. banks, but foreigners do not. They file a special form, and they get tax-exempt status. And the reason for that is global transfers of money. We live in a global economy now where capital can move anywhere instantaneously. And they do that purposely so that we can compete for capital globally. Because if we taxed foreigners, they wouldn't put any money here. They'd buy Japanese bonds. They'd buy European annuities. They wouldn't put anything in the U.S. We need to attract capital, so we offer reciprocal tax treatment. you only pay tax in your home country. You don't pay tax in the foreign jurisdiction. So when Europeans invest in the U.S., tax-free here. When we invest in Europe, tax-free to us. So that's the tax-free status. But for U.S. people, you're going to pay tax back home. Now, they don't issue the 1099 form, so it's back on the honor system, but you do get a statement of your income for the year, and you do put it on your tax return. You check the few necessary boxes disclosing it. But be aware that tax returns are protected by law from discovery. For asset protection, it's a private document that we file just with the government. As long as you don't give it to any third parties, it is protected from attachment. So tax neutrality, the jurisdictions we use, the Caribbean, many of the islands, Antigua, Bahamas, Bermuda, British Virgin Islands, Cayman Islands, Turks and Caicos, a lot of the beautiful islands in the Caribbean really market banks and trust companies and corporate services because they don't have a lot of infrastructure. They don't have a lot of manufacturing. All they have is tourism and banking and trust companies. So they really want to nurture that industry and attract capital. And if you look at it, places like Bahamas or Cayman Islands, they have a small population. They have a huge amount of capital within that country because of their favorable tax laws and their privacy jurisdiction. I would think about maybe 1/3 of global wealth is held in those type of tax haven countries. Now, Europe, we use Channel Islands, Isle of Man, Jersey, Liechtenstein, Luxembourg, Switzerland, Gibraltar, many more jurisdictions too. South Pacific, we have Cook Islands, Hong Kong, Singapore, many, many jurisdictions within Asia too. Now, what we typically want to set up offshore is a management portfolio, custody of assets. We want to minimize risk, and we always want to keep the currency that you put offshore back in the currency that you're going to ultimately spend it in, because you don't want any currency fluctuation risk. You can make 20% on your portfolio, and the yen drops by 30%, well, you have a net loss of 10%. Unless you're a sophisticated investor that understands foreign currency transactions, you're better off holding all your assets in the US dollar. Now, if you want to particularly buy a foreign fund that doesn't offer a US dollar fund, well, then we hedge back to the US dollar. So you buy a fund in Hong Kong dollars, but you hedge it back through a derivative back to US dollars. That means it's sort of like an insurance policy that you buy, that if the Hong Kong dollar drops, you're protected. You pay a small premium for that, but it's a small premium to pay for the safety of not knowing that you're going to be involved with currency losses too. Because it's one thing to make an investment decision and pick the right industry. You think computers are going to do well, or oil and gas, or you think healthcare is going to do well. Well, fine. You think Asia is going to grow, fine. But who wants to take the risk of government action with currencies because it's so volatile? So we always recommend back to the US dollar. And also, you should do a global portfolio. You know, even Alan Greenspan, head of the Federal Reserve, says that the US stock market's overvalued. Well, he's pretty much the one that manages the money for the country. If he says this is probably true. He's the one that can make decisions that can affect the stock market. If he increases interest rates by 0.5%, the stock market's going to drop tremendously. So I think what he's giving people a hint. You know, it's becoming a little bit of a gambling casino. You know, everybody's gambling with their wealth, you know, hoping that I call it the greater fool theory. You know, whatever you can buy it for, if someone will pay more than you paid for it, well, so much the better. You can keep going on and selling it. Well, someday that balloon can burst, like what we saw with the real estate bubble out here in California, perhaps even nationally. That things got a little bit overheated. When you get price to earnings ratios that get exponential, you just have to be very, very careful. So look at asset allocation. Look at diversification of your portfolio. Offshore, we have so much growth now potentially offshore. Asia hit the bottom of their cycle. Perhaps it's time for the upswing. Europe, too, is unifying. Time for investment. Don't put all your assets into one area. Don't put all your eggs in one basket. Globally diversify. Also diversify amongst industries. That way, if one's up, one's down, you're going to look at a nice diversified portfolio. You can earn a substantial return with minimized risk. That's why you need the ability to buy global assets. And the best way to buy global assets, offshore banking, because they're experts in that. You pick up the phone, talk to European bankers, they're going to know the European market so well. But you go down to your local Bank of America, they're not going to know anything. They might sell you a mutual fund off their list of 5 funds. They're not going to be into sophisticated investment strategies. Now, what we do is we set up the offshore bank account, and that's going to handle all the custody and assets. Well, we don't want to put that in your own name. We want to put that in a corporation name. So our first line of anonymity privacy and our first line of defense is we use a foreign corporation or foreign limited liability company, and that will hold the title to the bank account. So when your bank statements come, they're not going to be in your name. They're going to be in a company like East West Trading or Global Resource Group Limited. That's going to hold the asset. Now, you have complete control of that asset because you're the sole signatory. Because clients are always worried. They go, well, what happens if someone takes out my money? Well, the only way people can access that account is through signature. So by having signature authority on that bank account, you're the sole person that can control it. If you want even more control, maybe 2 signatures can be required to withdraw funds. So So you have to have a husband and wife together withdraw the fund, or perhaps two business partners, or perhaps two